Have you ever found yourself staring at the screen, heart racing, watching a coin or stock rocket up and thinking, I have to get in now, or I'll miss the move of a lifetime? Then, moments later, you find yourself frozen, questioning every decision you made, regretting the entry, and watching the market move away from you. That gut-wrenching, almost paralyzing feeling you just experienced is what traders around the world know as FOMO, the fear of missing out. And if you've ever traded while feeling that, you know it's not just an annoying mental tick. It's a dangerous force that can destroy profits and shake your confidence to the core. But here's the truth that most people overlook. Trading with FOMO isn't about opportunity. It's about emotion. Every time you chase a trade just because everyone else is doing it, you're letting your impulses dictate your financial decisions. You're allowing social media hype, the thrill of watching others win, and that nagging fear of being left behind to take control of your strategy. And while it might feel like the market is punishing you personally, it's really punishing your lack of preparation and emotional discipline. Today, we're going to tackle this head on. We're going to break down exactly how to recognize the triggers of FOMO before it even has a chance to influence your decisions. And more importantly, we're going to give you concrete strategies to trade with clarity and confidence. This isn't about vague platitudes like just stay calm or trust yourself. This is about creating systems, building habits, and understanding the psychology behind why FOMO hits in the first place. By the end of this video, you're not going to be the trader who jumps in out of panic. You're going to be the trader who makes calculated, confident moves because you've learned to separate emotion from execution. Even if you've lost trades, second-guessed yourself, or felt paralyzed by the thought that everyone else knows something you don't, you're in the right place. Because overcoming FOMO isn't just about protecting your capital. It's about protecting your mindset, your confidence, and your long-term growth as a trader. This video will give you the tools to turn those nerve-wracking moments into opportunities to strengthen discipline, build trust in your strategy, and finally stop letting fear dictate your decisions. So if you're ready to leave the chaos of emotional trading behind and start making moves with purpose and clarity, let's dive in. FOMO in trading doesn't always announce itself with flashing warning signs. Most of the time it creeps in quietly, disguised as excitement, urgency, or just a little curiosity about what everyone else is doing. You might notice it when you see a chart surging and think, if I don't get in now, I'll never catch this. Or when someone in a chat room posts a huge win and suddenly you feel the urge to jump in without checking your own strategy. At first, it seems harmless, almost exhilarating, but that's exactly how FOMO hooks you. It often manifests in very specific ways. You might find yourself entering trades on a pump without any confirmation, purely because the price is moving fast. You might take positions without analyzing your entry criteria or without waiting for signals that your system normally relies on. Sometimes it looks like closing a trade too early, not because the trend has reversed or your exit criteria were met, but because a tiny dip makes your stomach twist with fear. These are the moments where emotion overrides reason, and the market doesn't care about how you feel. It just keeps moving, often leaving you frustrated and doubting yourself. FOMO is also triggered by external forces. Social media hype is one of the biggest culprits, bombarding traders with success stories, memes, and alerts of someone else's big win. Watching others profit can make you feel like time is slipping away, like every tick of the price is a missed opportunity you can't reclaim. This isn't just about envy, it's a neurological reaction. Your brain is wired to notice potential rewards that others are getting, and it fires dopamine in a way that makes you want to chase it immediately. On top of that, there's the fear of missing the big move, the one trade that seems too perfect to pass up. You tell yourself this opportunity is rare, it won't come again, and if you hesitate, you'll be left behind forever. Understanding what FOMO looks like is crucial, because if you can identify it the moment it begins to creep into your decisions, you can intervene before it costs you. The first step is realizing that feeling urgent doesn't equal a high-quality trade. Recognizing your emotional triggers, whether it's social comparison, rapid price movement, or fear of missing out, is the only way to start separating instinct from strategy. FOMO isn't just about losing money. It's about losing control of your decision-making. Once you see it clearly, you can start applying techniques to manage it instead of letting it manage you. FOMO isn't just an annoying feeling. It's a financial and psychological trap that can cost traders far more than just a few dollars. When you act on fear of missing out, your decisions stop being strategic and start being reactive. Instead of following a carefully crafted plan, you're chasing the market, entering trades impulsively, and often sizing positions without proper risk management. Every time you trade out of panic rather than process, you're increasing the likelihood of mistakes, losses, and emotional burnout. The danger becomes clear when you look at how FOMO changes behavior. Impulse overrides analysis. A trader might see a coin or stock spike and immediately buy, convinced that the momentum will continue indefinitely, without considering resistance levels, trends, or volume. The excitement can make it feel like the opportunity is unique, like the chance of a lifetime. But in reality, the market is full of opportunities for anyone willing to wait and execute with discipline. When you jump late into a move, you often enter at the peak, and that's when losses happen almost instantly. You may hold on to hope as the price drops, thinking it will bounce back, only to see your account shrink and your confidence waver. FOMO doesn't only lead to losing trades, it also erodes your confidence and your ability to stick to a strategy. Imagine closing trades early out of fear, second-guessing every decision, or constantly comparing your results to others. Over time, this creates a feedback loop where your anxiety reinforces impulsive trading, and impulsive trading reinforces anxiety. The very act of chasing profits can make you doubt every rational decision you would have otherwise made, leaving you mentally exhausted and financially vulnerable. It's also important to understand that the market itself doesn't punish you out of malice. FOMO punishes your lack of patience and discipline. When you let emotion dictate timing, sizing, and entries, the market will consistently take advantage. The harsh truth is that the market rewards patience, discipline, and calculated action, not panic, urgency, or emotional chasing. By recognizing just how dangerous FOMO can be, you start to see why mastering it isn't optional. It's essential for survival as a trader. FOMO is dangerous because it hijacks the very traits that make a trader successful: patience, strategy, and confidence. Every time you succumb to it, you're trading against yourself, not the market. Once you understand the stakes, the next step is to examine why it even happens, understanding the psychology behind it, so that you can dismantle its power over your decisions. To truly overcome FOMO, it's not enough to just recognize it in your trading behavior. You have to understand why it exists in the first place. FOMO is rooted deeply in human psychology. It isn't just a bad habit or a lack of self-control. It's a survival mechanism that has been wired into us over thousands of years, and it shows up in trading in ways that are subtle, powerful, and often unconscious. One of the key drivers is the scarcity mindset. Our brains are naturally wired to assign more value to opportunities we perceive as rare. When you see a coin, stock, or trend taking off, your mind immediately labels it as something special that won't come around again. That urgency triggers a mental shortcut. If you don't act now, you'll miss out forever. In reality, the market is filled with countless opportunities every single day, but your brain doesn't process it logically in the moment. It processes it emotionally. Scarcity makes you feel like every single trade is make or break, which primes you to act impulsively instead of strategically. Another layer is herd behavior. Humans are social creatures. Since the dawn of civilization, following the group has been a survival strategy. Seeing others win triggers a subconscious comparison. If everyone else is profiting, maybe I'm missing something important. This herd instinct can be incredibly strong when amplified by social media, trading chats, or live market feeds. Your mind interprets the activity of others as proof of opportunity, even if the trades being made are completely unrelated to your own strategy or risk tolerance. You aren't just trading against the market, you're trading against your own instincts, which are screaming at you to join the group. FOMO is also fueled by the dopamine reward cycle. Watching others make money, seeing prices spike, or even imagining the profits you could earn triggers the same reward pathways in your brain as winning a game or receiving social approval. The anticipation of a reward, combined with the fear of missing it, creates a feedback loop where the emotional high of potentially winning overshadows rational analysis. Your brain starts to crave the excitement, the thrill of jumping in, which further erodes your ability to pause and assess whether the trade actually fits your plan. When you understand these psychological drivers, FOMO starts to make sense not as a personal failing, but as a predictable human reaction. It's not about laziness or stupidity. It's about instincts that served our ancestors well, but often misfire in the modern, fast-moving world of markets and social media. Once you recognize scarcity thinking, herd instincts, and dopamine-driven reward cycles as the engines behind FOMO, you can begin the process of rewiring your approach. Awareness is the first step toward control. The next step is learning practical ways to break the cycle, so that instead of reacting to fear, you respond with strategy and confidence. Breaking the FOMO cycle starts with a shift in mindset. The very first realization you need to internalize is that there will always be another trade. No single opportunity is so rare or so perfect that missing it will destroy your trading career. The market is a constantly moving ecosystem, filled with opportunities for those who are patient, disciplined, and prepared. This idea alone can dramatically reduce the urgency that drives impulsive decisions. Every time you catch yourself thinking, "This is my only chance," remind yourself that tomorrow, next week, or even later today, there will be another trade that aligns with your strategy and risk tolerance. Shifting your perspective in this way is not just philosophical, it's a protective measure against emotional decision-making. Another critical part of breaking FOMO is learning to focus on the process, not the outcome. When you're obsessed with missing a profit, you're prioritizing results over execution, which is exactly how FOMO takes hold. The more you measure your success by following your plan correctly, rather than by hitting a specific price or number, the less power FOMO has. Process-focused trading encourages you to evaluate trades by pre-established criteria, such as entry signals, position sizing, and risk management, rather than by the emotional highs and lows of watching the market move. When you trust the process, you no longer feel compelled to chase every spike or panic at every dip. Detaching emotionally from charts is another crucial step. This doesn't mean ignoring the market or avoiding analysis. It means creating a buffer between your emotions and your decisions. Many traders fall into the trap of watching prices tick by tick, feeling their heart rate increase, and letting each movement dictate their next trade. By establishing boundaries, like setting alerts instead of staring at every candle, or having a plan for when and how you review charts, you prevent your emotional responses from hijacking your decisions. Emotional detachment allows you to analyze opportunities calmly and objectively, making your trades deliberate rather than reactionary. Finally, breaking the FOMO cycle involves consistent self-awareness. Every time you feel that sudden urge to jump into a trade, pause and ask yourself, "Am I making this decision because it fits my strategy, or because I'm afraid of missing out?" Practicing this kind of mindfulness may feel uncomfortable at first, but over time, it trains your brain to recognize the early signs of FOMO before you act on them. You can even journal these moments, noting what triggered the emotion, how it felt, and how you responded. By observing patterns in your emotional reactions, you gain insight into your trading psychology, which makes it easier to catch FOMO before it translates into impulsive trades. Breaking the FOMO cycle is less about avoiding trades entirely and more about reclaiming control over your decisions. By shifting mindset, focusing on process, detaching emotionally, and practicing self-awareness, you begin to respond to opportunities with clarity instead of reacting with fear. This is the foundation for trading not just successfully, but with confidence, because each move you make is deliberate, informed, and intentional rather than dictated by fleeting emotions. Once you understand the mindset shifts needed to overcome FOMO, the next step is equipping yourself with concrete, practical tools that turn theory into action. Trading emotionally isn't just about mental mistakes. It's about a lack of systems, preparation, and structure. By implementing specific tools and routines, you create an environment where your decisions are guided by strategy rather than fear, and your confidence grows because your actions are repeatable and measurable. One of the most powerful tools is a pre-planned trading strategy. This is not just a vague idea of what trades you might take. It's a clearly defined set of rules that governs when you enter, exit, and manage positions. By having a strategy in place, you remove the guesswork that often triggers impulsive behavior. When a trade meets your criteria, you take it. When it doesn't, you walk away without guilt. A pre-planned strategy acts like a roadmap, helping you navigate the market without letting hype or urgency dictate your moves. Another essential tool is an entry and exit confirmation checklist. This checklist ensures that every trade meets your predefined requirements before execution. For example, it could include confirming trend direction, checking volume, verifying support or resistance levels, and assessing risk-to-reward ratios. The act of physically running through a checklist forces you to slow down, evaluate the trade rationally, and reduce the likelihood of jumping in emotionally. Over time, this habit trains your brain to prioritize objective criteria over fleeting feelings of urgency. Journaling is another practice that is often underestimated but incredibly effective. Document every trade you take, including the reasoning behind it, your emotional state, and the outcome. When FOMO-driven trades inevitably happen, reviewing your journal helps you identify patterns and triggers, giving you the insight needed to prevent similar mistakes in the future. Journaling reinforces accountability and allows you to separate your decisions from your emotions, providing a record that highlights improvement over time. Risk management and position sizing are equally critical. Even with a perfect strategy, emotional trading can wreak havoc if your positions are too large or your stops are ignored. By calculating risk per trade, setting stop losses, and adhering to position limits, you protect yourself from catastrophic losses and reduce the anxiety that fuels FOMO. Knowing that your risk is controlled gives you the freedom to stick to your plan, even when the market surges in directions you weren't expecting. Finally, setting alerts instead of constantly watching charts is an underrated but highly effective method to reduce emotional trading. Staring at live price movements amplifies stress and the urge to act impulsively. By using alerts for key levels or signals, you can step away from the screen, preserve mental clarity, and only engage with trades when predefined conditions are met. This technique allows you to treat the market like a system to interact with rather than a drama to react to, which dramatically reduces emotional hijacking. Incorporating these practical tools transforms your trading from a reactive exercise into a structured, controlled process. Each element, strategy, checklists, journaling, risk management, and alerts, reinforces discipline and minimizes the influence of FOMO. When combined with the mindset shifts discussed earlier, these tools provide a complete framework for trading with confidence, turning what was once chaos into a system where you are in control of your decisions, your risk, and your outcomes. Confidence in trading isn't something that happens overnight. It isn't born from a single profitable trade or a lucky streak. It is built, piece by piece, trade by trade, through consistent application of strategy and disciplined execution. The foundation of trading confidence lies in measurable, repeatable actions. When you consistently follow your plan, adhere to your risk parameters, and evaluate your performance objectively, your confidence grows because it is rooted in evidence, not emotion. Unlike the fleeting thrill of FOMO-driven trades, this type of confidence is resilient and sustainable. A key component of building confidence is understanding that it comes from data and practice, not luck or intuition. Each time you execute a trade according to your rules, you are gathering information about what works and what doesn't. Even trades that end in small losses are valuable. They reinforce your process, highlight areas for improvement, and teach you how your strategy responds in real market conditions. When you focus on these learning opportunities rather than the immediate outcome of a trade, your confidence shifts from being externally dependent, based on wins or social comparison, to internally grounded, based on your ability to follow a process successfully. Reviewing your trades regularly is another critical step. Set aside time each week to analyze your decisions objectively. Were your entries and exits according to plan? Did you follow your risk management rules? How did emotions influence your choices? By doing this consistently, you create a feedback loop that strengthens discipline and highlights areas where FOMO might be creeping in. This reflection is not about criticizing yourself. It is about building trust in your strategy and understanding your personal tendencies. Over time, this practice transforms uncertainty and doubt into informed decision-making and controlled risk-taking. Celebrating correct decisions is just as important as acknowledging mistakes. Profits alone are not the benchmark for success. If you enter a trade that meets all your criteria and manage it properly, that is a victory, even if the market moves against you and the trade closes at a small loss. By recognizing these correct actions, you reinforce positive behavior, strengthen adherence to your process, and gradually reduce the influence of fear-driven impulses. This approach rewires your brain to value discipline over results, which is the ultimate antidote to FOMO. Consistency also fosters patience. When you have faith in your system and know that opportunities are always coming, you're less likely to panic at each market movement. You begin to understand that the right trade is worth waiting for, and you can afford to let the noise pass without acting impulsively. This patience becomes a cornerstone of confidence because it signals control over your decisions, over your reactions, and over the inevitable highs and lows of trading. Ultimately, building confidence through consistency is about creating a stable internal framework. When you rely on process, data, and disciplined evaluation, you stop trading reactively and start trading deliberately. Each consistent action reinforces your ability to act rationally under pressure, weakening the grip of FOMO and allowing you to approach the market with clarity, calm, and conviction. Confidence, once established this way, is self-sustaining. It grows with every disciplined trade, every well-documented decision, and every thoughtful review. At this stage, after understanding FOMO, its psychology, and building consistent strategies and habits, the final step is adopting a mindset that fundamentally changes how you approach trading. This isn't just about following rules or checking boxes. It's about seeing the market, your decisions, and yourself through a lens that eliminates unnecessary fear and amplifies clarity. The central idea here is simple but transformative. You're not trying to catch every trade. You're trying to catch the right trades. This mindset shift reframes the way you think about opportunities. Instead of reacting to every price movement, market hype, or social media post, you evaluate trades through the criteria you've established in your strategy. You begin to understand that missing a trade is not failure, it is discipline. When you stop obsessing over every single potential gain and start prioritizing trades that align with your plan and risk tolerance, you reduce stress, make better decisions, and protect both your capital and your mental energy. The market will always have more opportunities, but your ability to trade them effectively depends on your patience and preparation, not your urgency. Replacing urgency with patience, discipline, and strategy is the cornerstone of this mindset. It means that you no longer allow price action or the fear of missing out to dictate your behavior. You trust the process you have built, rely on your checklists, and respect your risk parameters. This approach allows you to approach each trade with confidence and objectivity, even in volatile or fast-moving markets. When you think in terms of strategy instead of reaction, every decision becomes intentional. You are no longer chasing the market. You are engaging with it on your terms. Another component of this mindset shift is embracing emotional neutrality. Instead of celebrating short-term wins or punishing yourself for losses, you evaluate every trade based on whether it met your criteria and followed your system. This doesn't make you cold or detached from your trading. It makes you resilient. You stop allowing temporary outcomes to shape your emotional state, which drastically reduces the power of FOMO. By focusing on the quality of your decisions rather than the immediate outcome, you cultivate a calm, confident approach to trading that is sustainable over the long term. Finally, this mindset encourages a long-term perspective. Trading is not about chasing every surge or capturing every once-in-a-lifetime opportunity. It's about consistently applying a process, learning from each trade, and gradually compounding both skill and capital over time. When you adopt this perspective, FOMO loses its grip because you understand that no single trade defines your success. Your discipline, consistency, and strategy do. Every trade you take with clarity and confidence becomes a step toward mastery, rather than a reactionary gamble dictated by fear. This final mindset shift is what separates reactive traders from those who thrive. It transforms trading from an emotional roller coaster into a deliberate, controlled practice where fear no longer dictates your actions. by internalizing that you only need the right trades, relying on strategy over hype, and evaluating success by process rather than outcome. You take ownership of your decisions, safeguard your confidence, and create the conditions to trade consistently, profitably, and with real peace of mind. Now that we've broken down FOMO, explored why it's so dangerous, and outlined the mindset and tools to trade with confidence, it's time to put it into practice. Remember, the knowledge you've gained today is only as powerful as the action you take with it. Reflection without implementation is just theory, and the market rewards those who act deliberately, not those who simply watch and hope. I want you to take a moment and think back to your own trading experiences. Ask yourself, what was your most costly FOMO moment? When did fear of missing out make you jump into a trade, and what was the result? Now, imagine approaching that exact scenario today with the mindset and tools we've discussed. You would have paused, checked your criteria, and maybe even walked away because it didn't fit your plan. That kind of self-awareness is what separates consistently profitable traders from those who ride emotional roller coasters. If this video has helped you recognize your triggers, understand the psychology behind FOMO, and see that disciplined, process-driven trading is not only possible but sustainable, I want you to engage with this community. Comment below and share your experience. What FOMO moment cost you the most, and how did it affect your trading decisions? Reading and discussing these experiences not only reinforces your learning, but it helps others recognize that they are not alone in facing these challenges. Trading is a journey, and every story shared adds perspective and insight. Finally, if you want more content focused on trading psychology, strategies to strengthen discipline, and actionable steps to trade confidently, make sure you subscribe and turn on notifications. This isn't about chasing hype or following trends. It's about building the skills, mindset, and habits that allow you to engage with the market on your terms. Every video we release is designed to help you stay grounded, avoid emotional mistakes, and trade with clarity, patience, and confidence. So, take what you've learned today, apply it, and start transforming the way you interact with the market. The next time FOMO creeps in, you'll be ready, not to chase the move, but to act deliberately, according to plan, and with real confidence in yourself. The market will always present opportunities, but the difference between a reactive trader and a confident trader is entirely within your control. Start today, and let the discipline you build become your biggest advantage.